Hello and welcome to Market Domination. I'm Julie Hyman. That's Jared Blickery in for Josh Lipton today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here is your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Today we got hit by imports had a bigger drag. That's a very noisy series. Inventories were a little into play. These are not things that should change our view on the economy. It's been strong. It continues. The underlying pace continues to be strong. That's not bad for the Fed.
We all need to just take a deep breath here. Markets were overdue a correction. We've had this low volatility, 20% plus rally since October. We've forgotten what a pullback looks like. But hey, we get 3 of them a year. Your average S&P 500 intra-year drawdown is 14%. So I think we've just got to keep that at the back of our minds.
They're still very, very focused on controlling headcount costs. They kind of called out that none of this increase is really owed to anything from that perspective. So I would say from that perspective, year of efficiency is still very much in play. This is a capital expenditure issue where they're having to spend a ton of money to build infrastructure and obviously acquire GPUs to run their AI research and product development.
We've got 1 hour to go until the market close, and we're taking a look at the major averages. It's sponsored by Tasty Trade. We've got the Dow trading off right now by about 428 points, but you can see here coming off of the lows of the session to some extent, and that's a pattern that we see with the other majors as well. Of course, the S&P not down nearly as much as it was earlier, now only off about a 0.6%, and the Nasdaq down 0.8%. But really, there was sort of a 1-2 punch to the markets today. On the one hand, you have the tech trade being led lower by Meta. You just heard Brad Erickson commenting a little bit about that. And on the other hand, you had a GDP read for the first quarter that came in much lower than estimated at an annual pace of 1.6% versus the 2.5% that economists had been predicting. Part of that had to do with slower spending on goods. Part of it had to do with higher prices as well. But all of that is serving to push up yields. That sort of higher for longer mentality has taken root a little more firmly here, at least if you're looking at the 10-year yield at 4.71%. Let's take a look at the sectors here within the S&P 500. We've got communication services, of which Meta is a part, off 3.6%. And then you've got some of the interest rate sensitive sectors like real estate also lower, but then commodities doing better, materials and energy higher. Let's dig into the Nasdaq a little bit more here, because not only do we have Meta, which was down 11%. Again, you just heard Brad Erickson talking about it still might be the year of efficiency, but the amount that the company is paying, is spending on its AI build out is serving to be a little bit alarming to investors. So that stock down by 11%. To be fair, after a very big run up in the stock. But then, of course, we have a lot of companies coming out with earnings after the close of trading. We've got Alphabet, which is down 2.2% or 2.1% going to those earnings. And you got Microsoft, which is off almost 3% going into its numbers. So that is all going to be very much in focus here. NVIDIA, on the flip side, along with chips, which thanks to Jared for pointing this out to me, chips are actually behaving better today, up 4%. We've got Intel after the close. In other words, a lot going on, a lot to come. Jared?
Thank you, Julie. There is a lot of confusion on the streets here, but for more on today's market moves as investors digest the soft GDP data and prepare for another round of earnings, we want to welcome in Keith Lerner, the Truist Co-Chief Investment Officer and Chief Market Strategist. Keith, thank you as always for joining us here today. I'm wondering what you make of this latest data release and also the trip that we've seen in earnings, especially Meta down so much. This comes after we've gotten better than expected data on the labor market and inflation. So what should investors be focused on here?
Yeah, well, first, great to be back in studio with both of you. I mean, you described it well, Jared. We have a bit of a split market today. I will say, overall, we're actually becoming more positive as we've pulled back, and we're getting kind of this excess sentiment euphoria that we saw after 5 straight months of gains, that really strong first quarter. And even today, the GDP report itself, if you look underneath the hood, It was fine. It wasn't great, but it was fine. Consumers still spending, businesses are still spending. You saw some of the more volatile areas of that report, like inventories and trade, kind of bring it back. The underlying demand is fine. I think the market's hanging in there relatively well despite the yields moving higher. 4 or 5 sectors are up today. So what we've been saying to folks is we actually think the risk reward is somewhat improving as we pull back, as we work off some of that excess sentiment. And the other thing is, going back to interest rates, we did have a little bit of a hotter inflation number, but the market had already repriced the Fed so dramatically from early in the year. It's not having that same impact that it would have before.
And yet, it repriced the Fed so dramatically because it seemed like economic growth was strong, and that's what was pushing up inflation. Do we run the risk of a stagflation scenario here where things are not growing as much as people thought, but inflation is still not coming down?
Yeah, it's a risk. It's not our base case. And listen, this is one number. And again, if you look at the components of the GDP, it was still solid economic growth. And don't forget, underneath that today, we also had initial jobless claims at 207,000. So what does that mean? That means people are still working and wages are still going up, and therefore that should still power the economy forward. We've been expecting a step down from that really robust growth of the last 2 years after the pandemic, but we still think we're probably closer to 2%. And nominal GDP growth today is about 4.8%. And if you think about the stock market, that 4.8% should be good for sales, and that should be good for earnings. And one of the reasons why we maintain more of a positive outlook, especially as we're pulling back here, is that forward earning estimates for the market every week are making new highs. And we just saw that again. We think that's going to continue and provide a balance as far as, with this decline. I think from where we are today on our work, looking at the historical norms, we think, 2 to 5% is probably limits the downside from where we are today.
Yeah, I've seen a bunch of strategists saying there's a short-term opportunity, at least for maybe a couple-week bounce here, just given the setup. But I want to focus on sector action. Yep. You recently upgraded the energy sector. Yep. I have on the Wi-Fi Interactive year-to-date sectors for the large cap stocks. This is the S&P 500. Energy is up 15%. That is the number one sector. Guess what number two is? Financials and then industrials. Then we get one of the mega cap sectors. So things have changed here a little bit. Yep. Just wondering what's behind your energy call and what other sectors you might like.
Yeah, well, also going back to the economy, the market tends to be a leading indicator. What you just said, energy, financials, industrials, those are the most leveraged sector to the overall economy.
Yes.
So the market is telling you that we don't have a growth problem at this point. So we've been overweight financials most of this year. We upgraded industrials a few weeks ago. And then energy had a big move up. It pulled back, and then we upgraded it. Part of our sector strategy is based on price momentum, so positive price momentum and relative price momentum. Jared, I know something you look at quite a bit. The other side of it is valuations are still relatively cheap for the sector. And as energy prices have rebounded, we're seeing the earnings momentum also move forward as well. And I think it's also a good hedge for geopolitical risk as well. So I think it has different facets in this, as you said, kind of confusing market backdrop that we've been in here more recently.
So you are newly more positive on energy, but you have been positive on technology.
Yep.
And comm services, and it sounds like you're staying that way.
We are. We were positive on those areas for some time. With tech, it's typically 2 steps forward, 1 step back. And right now, obviously, like communication services, that sector is so dominated by Meta and Alphabet. So we'll have to see what happens after the bell today as well. But I think big picture on tech, it's hard to be negative on tech longer term because even if the economy does slow down, businesses will likely have to continue to spend on tech, otherwise be left behind. The other thing more fundamentally, what we look at on tech, when it outperforms is when the earnings momentum is stronger than the overall market. And so far, those trends are still intact. I will say we're starting to see more of that bifurcation. Like today, so Meta's down a lot, but the semiconductors, as you alluded to earlier, are up because Meta is going to be spending more money on CapEx, and that means semiconductor demand is going to stay high. So I think you're going to see more of that kind of two-way, more granular type of market likely continue.
I want to stick with that for a second so I can show this on the Wi-Fi Interactive. If I could get that up here. We have the semiconductor heat map today. You see NVIDIA here up 4%, Taiwan Semi up 3%. Looking for those Intel earnings after the bell. And then we switch over to software. That is night and day. So maybe this is an idiosyncratic story. Maybe this is they're outweighed by some of the IBM earnings, and maybe we can talk about this all day. But I'm just wondering, going forward, do you think? And you've talked about the overall market correction. What should investors who still like the Mag 7 trade really think? And who likes the growth trade? What should those investors think right now?
Yeah, well, I think often people think you have to be all in on one area of the market or all out, and I don't think that's the way you should be. And even this day, the Mag 7's like people are calling it the Fab 4, and I don't know after today maybe it's the Fab 3. I don't know. So the way we're thinking about it, we're still overweight tech longer term. We still think the earnings momentum, and we think the secular story is there. But to the point about energy and financials, those are things that will be positive for like the equal weight S&P. So what we're doing, even with the portfolios that we manage, we still have core positions in something like the S&P that is tech heavy, but we're diversifying that concentration risk, which we're seeing the last couple of days, with something like the equal weighted S&P, which again is basically every stock in that index is weighted the same, so you don't have that concentration risk. And if the economy still stays somewhat resilient, which we think it will, those areas should do somewhat better. So I think, and that's also going to the mix of these sectors that we talked about. You got growth and the more cyclical areas where we're still more negative as some of the defensive areas of the market that have been underperforming, having a little bit better day today, but we think that there's not a lot of value there at this point.
And just to go back quickly to tech and the sort of growth cycle and where we are in that growth cycle. So if the likes of a Meta, and we will find out more after the bell from the others, are spending, that's benefiting the semiconductors. When is it going to benefit the ones that are spending? When is it going to benefit them? I mean, we saw in the last spending cycle for Meta, it was spending all that money in the metaverse, and the market said, no thank you. And that maybe that's bearing a little bit of fruit, what it's spent on the metaverse, but
I mean, you're right. It's like
it's
when
you try to get your arms around.
Yeah, when is the revenue opportunity going to come in? I mean, the reality is they control the data, and I mean the next phase is going to be the more product releases, and then also the companies after that. Who's going to amplify this data as well? But the reality with AI, it costs so much money so they're spending all the money on semiconductors because they have the money, so they're going to have an advantage of exactly how that all translates and when is a difficult question. But I think longer term, I wouldn't bet against these big companies because they have the cash flow and the balance sheets to really stay in this longer term than some other companies that just won't be able to spend the money to be competitive in this field.
Yeah. Keith, thanks for coming in. Great to
Always
see you.
Always good to be with you guys.
Appreciate it. Well, another day, another big lineup of companies reporting after the bell. Microsoft will deliver its fiscal third quarter results with AI top of mind for many investors. Joining us with more, Yahoo Finance's Dan Halley. Dan, we've been talking all about AI. What are we going to hear from Microsoft?
Yeah, Microsoft really, I think the street is going to now look to see how much these AI investments are paying off. As you were speaking to prior, obviously Meta going through this huge spending spree. Microsoft, they've been spending for a while, and I think that the street is probably anticipating them to continue to spend, whereas with Meta, the whole narrative has been efficiency, efficiency, efficiency. But as far as numbers go, we're expecting Microsoft to report earnings per share of $2.83 on revenue of $60.88 billion. Last year, they reported earnings per share of $2.45 on revenue of $52.86 billion. The number to look for is going to be overall commercial cloud revenue. That's expected to be $33.93 billion in the quarter. And then if you want to drill down a little bit more to see how the Azure segment is going, that's for intelligent cloud, and that would be $26.25 billion is what's anticipated. There's a few things to look for here, in particular in Microsoft's announcement. Are we starting to see a payoff in some of the AI offerings that they have? They do have these enterprise services that use their co-pilots. They're opening that up more to the public. They're charging $30 per person. Then there's add-ons for that as well. And B is the PC market, if that's recovering at all. And that'll also have to do with the other chip makers as well, how much the PC market is recovering, because it's supposed to have had its first bit of growth for the first time in 2 years.
We were just showing the underperformance of software today, but chip stocks doing really well, and we have Intel after the bell. What can we expect there?
Yeah, for Intel, it's going to be similar, but not exactly from Microsoft. The question is not going to be how much are they spending on AI, but how much are they selling through AI. Obviously, NVIDIA having huge gains as a result of their AI accelerators being available, and companies snatching them up as fast as they can. Intel and AMD are the second layer players. AMD probably a little bit more than Intel, although it's always worth pointing out that while NVIDIA gets a lot of the play for the AI sales, rightfully so because of their accelerators, they still most of the time need CPUs, and those generally come from Intel. So they're still selling when it comes to AI, just not in the same kind of way. But regardless, Intel's launched its Gaudi chip, announced its Gaudi chip. They say that that's going to compete with NVIDIA's H100. Problem is, NVIDIA just launched its B100, B200 line of second generation, or next generation rather, Blackwell chips. And so that's where they're going to have to compete. There's questions about the foundry services. This is going to be their first time that they're reporting with that new reporting structure. Foundry services, they had broken out, said they're going to break out, said they lost $7 billion on that in 2023. But they do have a high-profile client that's going to be building chips through them. Microsoft, they're going to use them to build some of their chips. So we'll see how that goes. And then again, as PC sales have those picked up. Still the bulk of Intel's revenue.
All right, we're going to check back in an hour. Thank you for that, Dan. And another Magnificent Seven stock on deck to report earnings after the bell, Alphabet. Here with what to watch is Yahoo Finance's Ines Ferre. Ines.
Yeah, Jared, and just as Dan was mentioning about that AI spend with Meta, well, also investors will be keeping a close eye on how much Alphabet is spending on AI and expenditures there, and advances on AI, incorporating AI into its search, how broadly AI is being adopted, keeping in mind the missteps that the company encountered last quarter with Gemini's image generation. But despite all this noise, Google is expected to come out with strong results. So just to give you an idea, revenue is expected to exceed last year's revenue for the first quarter, coming in at $66.07 billion. That's what the street is expected. Adjusted earnings at $1.53 a share. That would be up from last year as well. Cloud revenue is expected to increase by as much as about 25%. Ad revenue is expected to increase as well. Now, these results are coming at a time where there is change at the company, with last week Sundar Pichai announcing some restructuring with the AI teams at the company, also some staff that had been fired because of some protests, with a clear directive from the company basically saying this is a business and not a place to act in a way that disrupts co-workers. So look, when we take a look at this stock, Alphabet, right in the middle when it comes to the Mag 7 stocks. It's up about 11% year to date. It's ahead of Apple, it's ahead of Tesla, but it's behind NVIDIA and behind Meta, even though Meta today is down significantly.
Thanks so much, Inez. Appreciate it. Looking forward to all of those numbers. And we're just getting started here on Market Domination. Coming up, we'll speak to Raymond James Financial CEO Paul Reilly on the other side about the company's most recent quarter. Those shares are sinking today. Plus, data management software company Rubrik making its highly anticipated debut on the New York Stock Exchange today. Our Brian Sazi will speak with Rubrik's CEO later in the hour. And another full round of earnings on tap after the bell today. We'll get the latest from Microsoft, Alphabet, Intel, and Snap. Stick around, much more market domination on the other side. Raymond James reporting record client assets and assets under management overall in the second quarter. Here to talk about the report and what's driving the increase is CEO of Raymond James, Paul Reilly. Paul, it's great to see you as always. You guys did grow assets to that record. The growth, however, in net new assets did slow to some extent. Can you talk to me about some of the dynamics that were at play in the quarter?
Yeah, so there's a lot happening in the quarter. If you look at, the last 3 years in a row now, we've had record revenue and profits and assets. For the first 6 months, including this quarter, we have record revenue, profits, and assets. So we've had great growth. And this quarter is a little bit slower, seasonally a little bit slower. There's always in and outs, but the truth is where we stand right now, we're on a pace for record recruiting of advisors. We have record size of advisors. A few years ago, we didn't see $5 and $10 million kind of advisor teams. We're seeing $20, $30, and $40 million teams now talking about joining us. So, so it's a quarter and a long run series of very, very good quarters. We've always been really right at the top of net new assets. We're more in the pack this quarter. So, but longer term, middle term, I think we're in really, really good shape. So stock was adjusting probably to that net new asset number, and we're happy to be judged on what we produce in the next few quarters.
Well, Paul, let me ask you, given your position in the retail brokerage industry, what kind of trends are you seeing? We've seen an incredible shift in trader investor behavior over the pandemic. Since then, just what kind of trends are you seeing?
Jared, we've seen all sorts of trends in that period since the pandemic, and probably the biggest movement was when cash was free. People had a lot of cash uninvested, and today they're getting a good return on that cash, whether they're going to money markets, fixed income rates, or into deposit programs that pay high yield. So that's good news for investors. That's available. We've also seen, pretty good. For a while, it was fixed income investments, but with the growth in the market, total position of portfolios and equities is actually up. So it's been a good time, for investors that have been in the markets. They've done pretty well. And of course, there's always a fear of what happens next. But investors have looked at, probably bigger penetration into alts products. We're pretty conservative on what we allow on the alts platform, but certainly a pickup on that side, trying to hedge, potential downturns in the equity markets. But pretty well, they're staying invested with their advisors. And I remember just a year or two ago where a lot of investors, private clients wanted to get out of the market and stayed in, and it's paid off well for them to get really the benefit of this rally.
And so, Paul, even more recently, as we've seen some more cracks in the market, one could argue, or at least a short downturn in the market, how would you describe investor sentiment, particularly in that private client group, which is, higher net worth individuals?
And you can see the reaction, Jill. Even ours, we had one number that was off. The market's sensitive right now.
Yeah.
And you're seeing that really kind of in all stocks, even on hits on quarters, just a little bit of something going on, you see adjustments. So investors a little more skittish. We still have 70% confident in the economy. Down, I saw the latest survey, over half were constructive on the market, so that shows the split nature and personality. But the good news for us, we're steady at 95% of people think their advisors are doing a great job for us. So, but investors, I think, like institutional investors, as you see small movements or data points really have big reactions in the market, I think people are a little skittish because it's been a long up market since, really 2010, as we've, had a pretty long recovery here, and I think people have been nervous.
Paul, since we spoke last, the news was announced that you have named a successor, the CFO of the bank, Paul Shoukry, who's going to take over sometime next year. And I'm sure we're going to talk again before that happens. But in the meantime, I am curious sort of what you want. I mean, you've been CEO there since 2009. So I'm curious what you feel you want your legacy to be at Raymond James. What do you think is sort of the biggest imprint that you've made on the organization?
Well, I tell people I only take credit for two things, is our big increase in technology, which has paid off really in making, I think, the best platform for wealth advisors anywhere. And the second is I haven't messed up the culture yet. We've had, 63 years of this tremendous culture, really started by Bob James and institutionalized by Tom James. And through my whole stay, culture's been number one. It's a very family feel firm, even for a big firm. Everybody's a first name basis. Advisors aren't afraid to reach out directly to me or anyone else here. And that was also critical as we picked my successor. We had 4 great candidates, all very capable. And we went through a multi-year process. And the question wasn't if those people couldn't be CEOs, who was best for the firm at this time. And with the mounting regulatory pressures and capital pressures, regulation in general, we felt that Paul was best equipped. The good news is all 4 have worked together for 15 years. They were all in the process, and they've all committed to stay together for the next 15 years. So I look at the transition of Tom James appointing me, and I felt my mission was to take it from the founder to the next successor. And I'm very confident, not just in Paul, but the whole team that'll be with him to continue the trajectory. I'm sure he'll do some things different, but the culture is sacrosanct. I know he'll continue to have this great advisor-centric, client-centric firm that we've always been. And he's been a big part of the things we've done, whether it's our success on the cash sweeps during, last March when there were runs on banks and we created deposits, through our capital programming. Even though analysts say we have too much capital, we still have really top ROEs in the market. And we have 3 A-level ratings in the rating agencies. And for a firm our size and that in our industry is unusual, unique, I would say. And Paul's been a part of that as the whole team. So to me, it's been a gradual passing over. And technically next year he'll be the CEO. And the good news is I'll be able to blame him when there's problems instead of him blaming me. So.
Well, I'll tell you what, quick note on culture here. Culture eats strategy for breakfast. So says Peter Drucker, famous quote there. I'm a believer as well. So thank you for joining us here today. Congratulations on your quarter. Raymond James CEO Paul Reilly.
Thank you, Jared and Julie.
And coming up, Royal Caribbean shares higher today after beating Wall Street expectations in their latest earnings report. We're going to speak to the cruise liner's CFO, Naftali Holtz, on the other side. So stick around, much more market domination still to come. Airline stocks on shaky ground. Southwest shares plunging as it now expects to recover fewer aircraft from Boeing in 2024 and closes operations at 4 airports. While American Airlines swings to a loss in the first quarter. And Julie, I was really concentrating on Southwest today. If we can go to the Wi-Fi Interactive, I have a heat map that shows a picture here worth 1,000 words. And here's Love. That's Southwest down about 7.18%. I'll just give you a 5-year chart so you can track. Here's that big pandemic drop. This is a stock that just never, oh, excuse me, that's Norwegian there. This is a stock that never really recovered. Southwest Airlines looks very, very similar. So here's that pandemic drop, and you can see down there by those lows, Julie.
Yeah, and the company, you know, as part of its announcement, just a number of different things that are weighing on the shares. Costs to fly each seat a mile are going to rise this year as much as 8%. That's higher than had been anticipated. So higher costs here. The company is no longer going to be flying into 4 airports, including George Bush International in Houston, the International Airport in Bellingham, Washington, Syracuse, and Cozumel in Mexico, because it just doesn't make money at those spots. So it is trying to retrench here, but not enough to please investors. And then you look at American. American, I think, is really interesting because the company actually came out, you know, we always on this show say pretty consistently, guidance is usually outweighs the last quarter. But in the case of American Airlines, it didn't really happen. The company's yes, the shares are moving up a little bit, but they seem to be held back by the fact that last quarter the numbers disappointed, which is kind of interesting.
Yeah, and I just say in Southwest in general, a lot of its woes, anytime there was a Boeing headline that sent Boeing stock down, Southwest Airlines would kind of just overreact.
Southwest Airlines would. Yes. American Airlines, on the flip side, is not as exposed to Boeing, so that's one of its relative advantages right now.
You bet. All right, while the airline industry is hitting turbulence, cruise lines are charting a different course. Royal Caribbean beating Wall Street expectations on the top and bottom lines. The cruise liner citing strong demand and strength in onboard spend as key drivers in first quarter earnings. Meanwhile, the company also looking at an upbeat profit forecast for the year. Here to discuss is Royal Caribbean Group CFO Naftali Holtz. Thank you for joining us here today. So record bookings by a couple different metrics, strong guidance. Just give us an overview of your quarter, please.
Yeah, hi Jared, good to be with you. We were very, very pleased with what we reported this morning. We continue to see very strong demand for our vacation experiences. We increased our revenue guidance for the year and obviously the earnings as well. We see a lot of very engaged consumers new to our category coming in. We increased our new to cruise category by 16%. Versus the first quarter of last year. And we're seeing continued strength both on ticket as well as onboard experiences that really engage consumers that comes to spend the time and vacation with us. So we're very pleased both on the revenue side and obviously 60% year-over-year earnings growth.
Naftali, the numbers have been consistently strong, and I know that your forward bookings are also ahead of where they were last year at this time. Are there any signs of slowing whatsoever as you look across your different properties, as you look at the amounts that people are spending on ship, et cetera?
Yeah, so as you noted, we see strength across the board. Obviously, the booking levels, the pricing for that. And remember, cruise is an exceptional value proposition for people today, and we see those choices coming to us, to our brands, to our vacation experiences. We see more people engaged on buying more experiences on the ships, actually planning and booking them earlier than before, just to make sure that when they get on the ship, they get the best vacation experiences there. Very, very strong across our brands, across demographics and itineraries. Obviously, the US and the Caribbean has been exceptionally strong. That has been very consistent, and we've seen that also in Europe, Alaska, and other itineraries and that we operate in. So it's really strength across the board.
Naftali, I'm looking at a chart on our Wi-Fi Interactive of RCL, that's Royal Caribbean, a 5-year chart, and this shows that this stock has exceeded the highs that we saw before the pandemic. And I got to say, when I saw this drop here, I had to wonder, when is this stock going to be able to come back? And I said that for a lot of travel stocks, and there you've done it. Any hangovers from the pandemic, or is it just full speed ahead now, thinking about the future?
Yeah, we're very much looking forward to the future. Obviously, when we went through the pandemic, we had to raise capital and dilute to shareholders. So we had to kind of work extra hard to overcome that. And we've done it through making sure first that we deliver the experiences that our customers want and need. And really, that has been a driver of that. At the same time, growing the top line, we really focused on cost to making sure that we enhance margins. And that allowed us to pay down the debt, and some of the debt that we've raised through the pandemic, and obviously overcome the dilution. But our focus is straight ahead. We have our Trifecta program. It was a program that basically allowed us to get back to base camp. And now we expect to achieve it this year. But our ambitions are much, much higher. We want to continue to grow the company, moderate capacity growth, moderately grow our yields, strong cost control, enhance margins. And we're doing that. We're delivering ships this year and over the next couple of years. We have Icon of the Seas that just delivered, Utopia. We're investing in destinations. We just earlier this year opened the expansion of Coco Cay. We have announced 2 other developments, one in the Bahamas and one in Mexico, that are creating amazing beach experiences for our customers. We're investing in our technology, in our commercial apparatus. So there's a lot of exciting things for us. So for us, this is just exciting years ahead. We've stayed very, very focused that we play in a $1.9 trillion vacation market. We're a $65 billion category. So you can see that there's so much more opportunity in the years to come to continue to grow the business and take share from that amazing and very attractive market.
Naftali, what's going on the pricing front as you see this continued strong demand? How much pricing power do you feel you have? And those forward bookings that you're seeing, what price have you taken on those?
Yeah, so first, it's a very, I think it's important to note that cruise remains a very strong value proposition for the consumer. Historically, before the pandemic, we had probably 10 to 15% discount to land-based vacation. 2 years ago, when we were starting to come back, we were around 45%. It was just very, very compelling. So we've closed the gap a little, but we think there's still opportunity to close the gap to land-based vacation. And we're doing that with the offerings and the experiences we offer, the new ships, the new destinations, making sure that we are tailoring the vacation to the consumer. And what we found is that if you do that, obviously people want to spend on those, to spend on experiences and really tailor those vacations for themselves. So we've seen great progress on that, and we think we can do more as we continue to grow the company.
Thanks, Naftali. Good to see you. Thank you.
You too.
Now let's get to some more trending tickers that we are watching today. We've been watching Caterpillar consistently here, trading lower after delivering mixed first quarter results. The company also warning of slower second quarter sales. The shares down by 6.3% right now. The company says dealer inventories of its machines are going to decline in the second quarter and that its adjusted operating profit margin will be pretty similar to what it saw for the second quarter last year. Caterpillar has been holding up relatively well here, so it's interesting that we're now seeing, and I remember, was it pre-pandemic when Caterpillar came out with that warning and everybody kind of...
That was a long time.
Yes.
Oh,
I know. I've been doing this too long. But,
Me too.
So it's interesting. I wonder, is this the beginning of another cycle for the company?
Good question. Bloomberg Intelligence has a couple words they've penned kind of over this. I'll just start at the beginning. Even as demand continues to moderate in this year, 2024, Caterpillar's better than anticipated first quarter earnings, they indicate a more resilient business with structurally higher margins. So regardless of where we are in the cycle, there's some optimism for the future. And here's another one. Despite the solid first quarter margin performance, a larger than anticipated dealer inventory build, that's something you notice, as retail sales continue to soften, that remains a risk. But they're expecting Caterpillar is expecting a second half sales recovery. So maybe that's where we will end up standing. I want to go to the Wi-Fi Interactive real quick where I can just Here is our industrials and materials heat map, and Caterpillar just really stands out here. And I'm going to show you the year-to-date totals. Industrials have performed really well this year, one of the leading sectors and kind of a sleeper story, but lots of green on this screen here.
Yeah, most definitely. And Caterpillar, not up the most, but not too shabby with 15%.
Not too shabby. All right, Bristol-Myers Squibb shares sliding in today's trade. The company announcing plans to slash jobs over the next year and ending roughly 12 drug development programs. Anjali Kemlani joining us here to discuss. Anj, what are the details?
That's right. As you mentioned already, looking at those cuts, as well as a drop in one of its key drugs, Opdivo, 6% down there, as well as the job cuts are nearly 2,200 jobs by the end of this year and 1.5 billion in cuts through 2025. That's what's really pressuring the stock today. We know that some analysts are surprised by the large sell-off today. JPM saying that it was surprising and overdone despite the messy quarter that Bristol-Myers Squibb presented, because at the end of the day, they did also see some upside. Revenues up 6% in the first quarter year over year with nearly 12 billion coming in. And that's based on some of the M&A activity that they've done in the last year with their new leadership, looking at areas where the newest drugs that have become part of their pipeline are part of that. But they are also looking out for the future, that long-term growth. That's what this move today really looks at. Both Eliquis, which is the drug that is currently with negotiations with Medicare, as well as Opdivo, have their patent cliff in 2026. So the moves the company is making now is to brace for that patent cliff. So it looks like, all told, trying to make some good moves.
Yes.
Despite all the negative sentiment.
Yeah, interesting there. I mean, it was a busy day for the drug industry, for you, I'm sure, because we also heard from Merck and we heard from AstraZeneca. So give us like the
nutshell version.
Yes.
Cliff notes. Both others doing pretty well. AstraZeneca looking at their broader pipeline as well as their cancer in particular, really surprising there, as well as rest of world. So they looked at outside ex-China from their emerging markets, and that was a 40% bump there. So interesting news out of AstraZeneca there. Meanwhile, Merck, Keytruda, of course, their blockbuster that they're looking at giving positive results out there, as well as Gardasil, the vaccine that they have, 2.2 billion from their Keytruda contributing nearly 7 billion, up 20% year over year, all for a total of 15.2 billion for the quarter. Not bad.
Wow, not bad. Demand for Keytruda continues. Thank you so much. Appreciate it, Anjali. Well, coming up, data management software company Rubrik making its highly anticipated debut on the New York Stock Exchange. Our Brian Stasi will be speaking with the company's CEO on the other side of this break. So stick around. Much more market domination still to come.
Welcome back to Yahoo Finance. It may have been a down day for markets today, but there's one stock doing pretty darn well. That is Rubrik, newly issued public company, I should say, in Rubrik. Let's get right to the co-founder and CEO, Bipul Sinha, who really big day for you guys. Congratulations.
Thanks, Brian. It is so exciting to be here for all the Rubrik employees, customers, partners. What a momentous day. Thank you so much for this opportunity.
I talked to one of your early investors over at Lightspeed Ventures, and he noted that it was an oversubscribed IPO, a lot of enthusiasm. Why do you think that's the case?
Look, every investor is looking for quality asset to own, the asset that has durability, differentiated product in a large market. And we have been preparing for this day for several years now, and here we are. We are ready, market was receptive, we entered the market.
What were some of the biggest questions that investors gave you on the roadshow?
Questions around what is the product technology, what is the differentiation, is that differentiation sustainable, what is this, why this market so hot, what is the differentiated angle within cybersecurity, because as you know, the traditional cybersecurity, there's a lot of vendors. We are in a new cybersecurity, which is all about recovering from cyber attacks and continue to run the business. If you are a hospital, you know that attacks will happen to you. How do you keep the hospital going even when there is a successful attack? So all the questions around, is this fundamentally a long-term, durable, good business?
Is it?
I hope so.
I hope so. So talk to us about, should investors view Rubrik as a pure play AI play?
Look, we are a cybersecurity company focused on data security, but AI is a significant part of it. As you know, attackers are deploying AI to attack, and we are deploying AI to defend. We released a product called Ruby, that is the AI data defense and recovery that uses generative AI to help the IT operations team do cyber recovery. It's all about productivity of the IT operations, security operations to deliver the cybersecurity outcome.
We're really, I think, in a special or an interesting moment with AI. I mean, it has really taken off. It's a really, in many respects, an explosion, and it's supposed to stay like that over the next decade. You know, how important will it be for companies to protect their data, and how bad could cyber attacks get?
Look, AI fundamentally is based on data. If you don't have integrity in your data, if you don't have trust in your data, AI is garbage in, garbage out. So every business has to make sure that their core asset, that is data, is protected, available on the right platform at the right time for the right duration, for models to work, for models to infer and give you business intelligence. Our focus is that your data is secure and available so that you can run AI as well as BI.
Bipul, you're also a venture capitalist. I mean, you've done an engineer by training, worked at Oracle, right? And IBM. Yes. You have to have some views on AI. You know, do you fear that AI will be doing bad things?
Look, any technology that you pick, there can be good use of technology, there is a bad use of technology. We are already seeing threat actors deploy AI to attack us more. As we are increasing digital intensity in our life, for example, we get up in the morning, check our phone, use our phone to drive to work. And as we do more of digital activities, there will be more attacks, and AI will be used to attack us. That's why it's very important for good guys to use AI for defense, use AI for productivity, use AI for more drug research, more positive things. And there is always a balance. Are we doing more good with AI, or are we letting bad guys win with AI?
If the average investor coming to Yahoo Finance today, they might be coming across your company for the first time. You have had a history of losses. You noted that in the prospectus. Within the next 3 years, are you profitable?
Look, we are in a very interesting market. It's a new kind of cybersecurity market, focus on cyber recovery. We have a differentiated product, and we are creating a long-term value. Having said that, profitability is paramount. We have path to profitability. We are building profitable growth, and we want to be a highly profitable business.
One thing stood out to me in your prospectus, and it was your letter at the top of that, Bipul. You noted that maximal thinking is how you got out of poverty. Tell us a little bit about your personal story.
I grew up in India. My dad was an unsuccessful entrepreneur, grew up extremely poor, but he gave us this idea that you can become anything you want to be. And that idea is very powerful, that belief that you have self-agency, you can take matter in your own hands and figure out a way out of change the situation. 27 years ago, came to America, I call myself more American than American because I'm very passionate about America, because think about a guy with $100 in the pocket coming to America in 27 years, taking a company public.
How did you
It's an amazing story.
How did you make it happen? I read an interview maybe a couple months ago that you did. You essentially founded Rubrik from coffee shops. You were trying to find talent, and you were set up next to Google and YouTube headquarters.
Look, at the end of the day, all great companies are built when the cool kids are not going in that direction. When everybody is going in some direction, there is no value. We identified backup and recovery as a market that has not been innovated on for 20 years. And our idea was to transform this market, transform this industry towards cyber resilience and cyber recovery, because natural disasters don't happen every day. Cyber disasters are happening every day. And that idea needed top-class engineers from Google and Facebook and other places. And it was hard to recruit. So we sat at the coffee shop, cold called people and convinced them that will amount to something, and here we are.
This must be a pretty wild experience for you, from coffee shop, well actually from poverty to coffee shop to the floor of the New York Stock Exchange. Has this sunk into you at all?
We are just the beginning. Look, life arc is bigger than what one thing that happens to you. Obviously, this is a momentous occasion. It starts the next chapter for Rubrik, but we believe that we have tremendous opportunity in front of us. And as a company, as a group of people, we are here to take advantage of the opportunity and build an enduring company.
Where do you see Rubrik a decade from now?
Look, if you think about it, Rubrik is all about data and security of that data. And if you think about AI, AI is all about data. AI is pulling data from all the nooks and crannies of enterprise. We have all of the enterprise data in a single data format with cybersecurity built into it. We have an amazing opportunity to parlay this data to create the future of generative AI, and those are the areas that we'll explore.
All right, go get some rest. I know it's been a long few weeks for you. Bipul Sinha, Rubrik CEO and co-founder, good to see you.
Thank you,
Congratulations on Public Company Life.
Opportunity.
There you go, Jared and Julie, another top AI play coming to market here. A lot of folks that I've been talking to lately suggest this is a start of things to come, that the IPO market is likely to come back in the second half of this year.
We shall see. Creaking open, definitely. Thanks so much, Saz. Appreciate it. And we're minutes away from the closing bell on Wall Street, so we do want to check in where we stand for the major averages. And where we stand is not quite as bad, not nearly as bad, in fact, as we were this morning following the GDP report and the first sort of negative reaction to Meta. And I go back, Jared, to what we heard from Keith Lerner at the top of the show, where he said, sure, stagflation is a risk, but it's not our base case. So it does seem as though the GDP report this morning, for many market participants, did not fundamentally change their view of the economy and what the Fed is set to do.
I think that's important an important point to make, and I would add that the general market just sold off the futures. Stock futures sold off at 8:30 a.m. But then I keep thinking about, I'm going to show some heat maps later on after the bell, the difference results from software and semiconductors. Yeah. Semiconductors screaming higher, software in the red. Just shows you maybe it's an idiosyncratic story instead of just a broad market story.
Right, and interesting that, again, to go back to what Keith told us, that if Meta is spending money this year to beef up AI, who's getting that money? The semiconductors, at least
Very good
in
point.
part. Yes, indeed. All right, on the other side of the break, indeed, as promised, we'll be getting you the latest from Microsoft, Intel, Alphabet, Snap. Stick around. Market domination overtime coming your way with all of those numbers. There's the closing bell on Wall Street, and now it is market domination overtime. Let's get you up to speed on today's action, sponsored by Tasty Trade. So we did see a sell-off in the markets that did abate by the day's end. The Dow not even falling 1% when all was said and done, about 375 points. The S&P 500 off about 0.5%, and the Nasdaq off about 2/3%. But all of them well up off the lows of the session. As Jared, as you mentioned this morning, we had that quick sell-off when you had the GDP number cross at 8:30. But since then, things have sort of
steady slug back to the not always the upside here, but just taking a look at the Wi-Fi interactive materials, the best sector, energy the second best, industrials also in the green, but communication services, that Meta number really taking the brunt, down 3%. And I just want to show one more time software today. Bad, pretty bad. We're going to get Microsoft results in a second or a minute here. Semiconductors, just the opposite story. So really interesting to note all of these differences here, Julie.
Yes, indeed. Shall we get to Microsoft?
Are we
ready for that?
I would hope so.
I'm ready for that.
Let's go to Microsoft.
All right, let's talk about Microsoft here. The company's revenue coming out ahead of estimates. It looks like $61.9 billion, $60.87 billion is what analysts have been anticipating. So in other words, that is better than anticipated. Earnings per share of $2.94, trying to focus on whether this is indeed a little bit better than estimated. Don't see the comps yet for that earnings per share number. Cloud revenue, which was definitely a big focus for investors, it looks like at $35.1 billion. That is ahead of the $33.9 billion that analysts have been predicting. The shares rising a quick 5% here, and I think that cloud revenue is a significant part of this. People were looking for a lot from Azure, big expectations for growth there, and so that's one of the areas of growth. I'm also seeing a number for personal computing revenue that is ahead of estimates. So seeing the positive sort of first blush reaction there from Microsoft.
Not only that, Julie, I was noticing that given the strength in the cloud, I'm also seeing Amazon shares up 3%. We're going to get those earnings next week. If we can go to the Wi-Fi Interactive, I think this is kind of fascinating. This is our cloud and database and software heat map. Now, all that red in the background, that was what happened today, but these little rectangles down here, 5.52%, that's Microsoft after hours. Here's Amazon, 2.21% after hours. So that cloud strength really just kind of spreading to some other industries there. You can also check out our cybersecurity heat map here, not really seeing much there. And then we want to go to our general software heat map, and this includes Microsoft, the big company on the left there, but not seeing too much movement to the up or downside in a lot of these other issues. But I really thought the movement in in Amazon was quite interesting.
Yeah, that is quite interesting. I'm looking a little bit in the earnings release here for Microsoft just to see if we get any color here. Of course, you get a Copilot mention from Satya Nadella, which is the AI-powered sort of assistant in Windows. So he said the Microsoft Copilot and Copilot Stack are orchestrating a new era of AI transformation, according to Nadella. So he talks about that driving better business outcomes across every role and industry. So really pointing to what's happening as a result of productivity and business processes and cloud revenue as a result of that, and really pointing to Copilot as part of the reason behind that. I should mention that the company is going to be giving its earnings call. That's where we get the guidance from Microsoft. So we don't yet have guidance from Microsoft. We have to wait for the call for that to happen. We do have Alphabet numbers.
Yes, well, we also have Josh Schaefer here. I want to bring you in and take advantage because you might have some comments on Microsoft first.
Yeah, Julie was just hitting on that we haven't really gotten the guidance there from Microsoft, and I've noticed over the last couple of quarters that's usually when you start to see the stock move a little bit more during the call when the CFO will start addressing that guidance. So it'll be interesting to see overall, I think, how shares react. But you guys highlighted some growth in cloud. That seems to be a relative positive for Microsoft, and that's part of where a lot of their AI monetization comes. It's come in Azure, and so it's interesting to see that. I think that's what investors have been looking for when it comes to this stock is AI. Microsoft has been a little bit further along, in my opinion, in the AI story, where they're starting to see AI contributing to revenue a little bit more, and people actually have real metrics that they're estimating in. Microsoft has been mentioning that on these calls, so I'd be curious to see what we learn more throughout the call as far as how AI directly, because we know they're investing a lot in it, is contributing to that revenue growth they're seeing.
Okay, let's get to Alphabet.
Yes.
And let's just get right to it. The company's declaring a dividend. Here we go. That's what
Finally.
investors had been
20
waiting
cents.
for. Alphabet declaring cash dividend of 20 cents a share. And this is as Alphabet reports revenue that beats estimates. It's revenue excluding traffic acquisition costs, which is the convention that we use when we look at that Alphabet revenue. $67.6 billion. That looks to be more than $1 billion better than what analysts have been anticipating. Analysts are looking for $66.07 billion. And the company also authorized a repurchase of up to an additional $70 billion worth of shares. So it is returning cash to shareholders in a big way. We've seen other big tech kind of pave the way, and there was this waiting game for Alphabet here. Just running through some of the other numbers, earnings per share comfortably above estimates at $1.89, $1.53 is what analysts had been anticipating. And then looking through here, cloud revenue for Alphabet, $9.6 billion. Remember, it's number 3 when it comes to the cloud, right? You've got Alphabet, you've got Amazon, you've got you've got Microsoft, you've got Amazon, you've got Alphabet. So $9.6 billion or so in cloud revenue. YouTube ad revenue at $8.1 billion. That's better than estimated. Ad revenue for Google itself, better than estimated. And the so-called other bets category for Alphabet, also better than estimated. The shares getting a big pop here in the after-hour session on these numbers.
Yes, and I'm just looking at the Wi-Fi Interactive. I have the Nasdaq 100 heat map up, and you can see in these little rectangles here, those are the after-hours quotes. Google, Alphabet up 12%, and just checking back into Microsoft up 5%, Amazon 4%. So we're seeing just a lot of follow-through in other securities as well. And there was that $70 billion share buyback. Investors love that. Josh, let me bring you back in here. Any comments on Alphabet earnings?
Yeah, Jared. I mean, it just sticks out to me. You see the share buyback and you see the dividend, and I think back to Meta last night, and really Zuck and Meta did that last quarter, right? And we saw a big move in the stock for Meta then, and maybe when you start to put these stories together, maybe Meta was just a little bit further along in sort of their version of repurposing things and growing, and maybe that's how we can start to understand all of this big tech story within one, was that we're just at a little bit of a different stage, because I think certainly when you look at these different releases that we're looking at right now from Microsoft and Alphabet, and we think back to Meta last night, it's not like we have some large takeaway here that ad growth is slowing, that cloud is slowing, or something like that. And I think that that is perhaps from a broader market perspective, probably a welcome sign for investors, that we're not seeing big tech as from a broad sense, missing earnings or issuing guidance that is concerning, because I do think there was a little bit of a concern of that after last night's Meta results.
Right, well, we have to wait to get the Microsoft guidance, right? And I think the other question here is going to be around costs.
Yeah.
So when it comes to Alphabet, for example, as we talk about where they are in the cycle, whether it's returning cash to shareholders or where they are in the AI spending cycle, how are investors going to feel about Alphabet's spending plans on this area? Because clearly they were not happy about the CapEx plans for Meta in the same vein there. So, we don't have, again, that forward-looking information as of yet, but the company does talk a little bit about the costs. They talked about that they've been consolidating teams. This is something they previously announced, that are focused on building artificial intelligence models across Google Research and Google DeepMind to try to speed up that whole process. We'll have to get, again, more information on what the costs around that are going to be going forward. But that's something that, at least for me, is going to be a question on the call.
And it's easier to explain potentially maybe increasing CapEx, right, or talking about CapEx when you're Alphabet, but you did just buy back shares and you did just initiate a dividend.
Right.
When it comes all at once like that,
I think it's trifecta. That's
it's
how you
easier
return.
for investors to digest that, right? Rather than just talking about spending more and sort of the buyback is in the rearview mirror and the dividend is in the rearview mirror. I think maybe it's easier to take all of that information in at once and feel a little bit more comfortable if you're an investor.
That makes sense. Sugarcoat it, right? Or your little spoonful of medicine makes the
little good,
sugar
little
makes
good,
the
little
medicine
bad.
go down.
There you
Yes,
go.
but
Exactly.
we don't know what the medicine is yet. So to be fair, let us get to Intel, because those numbers are also crossing in the past few moments here. So here we have the company is coming out with its forecast already, and that forecast is below what analysts had been anticipating. So I'll go straight there. Second quarter revenue, Intel sees at $12.5 to $13.5 billion. Analysts had been predicting $13.6 billion. So the forecast below. The company also says second quarter adjusted gross margin will be 43.5%. Analysts had been looking for north of 45%. So two areas of disappointment when it comes to the forecasts here. When it comes to the first quarter numbers that Intel just announced as well, just to go through them for a moment here. That company, of course, also pre-announced some of its numbers, but it says its first quarter revenue was $12.72 billion. That's roughly in line with estimates. Adjusted gross margin at 45.1%, a little above the 45.5% that analysts have been anticipating. But again, Intel recently came out, talked about a restructuring it was doing where it was sort of making more clear what its foundry business, it's sort of making that more of a separate business, its foundry business, that which makes chips for others, although for now, it mostly makes chips for Intel itself. And analysts are predicting that's what it's going to do for quite some time, which is part of the problem for Intel.
That's a really good point, because the way the chip industry is structured, not all chip companies make their own chips. And so Intel makes chips for other people. Taiwan Semi is probably the biggest foundry in the world. Samsung is also a big player. But when we think about some of these Intel results, they have their Gaudi chip, and Dan Holley was just talking about that. It's 18 angstroms or 1.8 nanometers, 10 angstroms to the nanometer. Had to look that up. So that compares to the Taiwan Semi. Their foundry goes down to 3 nanometers. So this Intel's Gaudi chip could go below that, but bottom line, the competition has just kind of eaten Intel alive. For years, they were competing with AMD. AMD kind of ate their lunch in the PC business, and then they just don't have the stronghold that NVIDIA does in some of these higher performing chips. So we'll have to see how this works out, but not as much excitement over some of these new foundries as they were hoping for, I think.
So Jared, off that, do you feel like this is less of a solid read than into the chip sector? A company like Intel not necessarily living up to expectations. Does that not give us necessarily?
I think the guidance, the guidance is bad. Let me go to the
Intel is more idiosyncratic, to your point. Intel is so, but many of the companies in the semiconductor industry are idiosyncratic, right?
Sure.
Intel is giving us Intel is more PC based, right? So it gives us more of a read on what's happening in PCs. But then, because it is trying to make this big foundry pivot, that's sort of its own thing, so to speak. Its Gaudi chip does compete with NVIDIA's new suite of chips.
Right.
But it's still new, and NVIDIA is still dominant in that area. So there are areas of overlap, but Intel is also pretty idiosyncratic.
Yeah, it's a little bit of a different story.
I guess how I would answer that, right?
Yeah. And I think one other thing that just stuck out to me looking through the different numbers here, and we mentioned there are several metrics here that could potentially be driving the stock down. But one thing that sticks out to me is just that second quarter revenue guidance, thinking about how the market has reacted to revenue specifically this earnings season. Revenue has been heavily in focus when you look at stock reactions that we've seen in the one day after earnings. It's actually been more heavily focused on by investors than earnings. Companies that miss on revenue and miss on revenue guidance are seeing more negative stock reactions than if they miss on EPS. So it'll be interesting to see sort of if that continues to play out once we actually open tomorrow and what happens to Intel shares. But revenue and sort of the demand story seems to be one of the prevailing themes for companies thus far.
All right, thank you for that, Josh Schaefer. And we got to go now. We're going to help. We're going to get some help to break down the latest numbers from Alphabet. Angelo Zeno, CFRA Research Senior Equity Analyst, and thank you for joining us here today. Microsoft stock up 4.69% in after-hours trading. But your first blush look and opinion of these earnings.
I think you got to love them. Definitely a drastic change to what we saw last night. And you kind of look at the results. Both companies beat on the top and the bottom line. I think what the street really cares about more than anything is the cloud numbers. And the cloud numbers looked absolutely fantastic for both companies. When you kind of look at the beat, I'd say on both sides of things, I mean, definitely Alphabet looked a little bit more impressive. And that's why you're seeing kind of the more pronounced move on that side of things. But Alphabet also doesn't provide guidance the way Microsoft does, as well as Meta does. So that you've always got the potential for a bigger surprise or a miss on Alphabet's side of things. But in this case, definitely the trajectory is moving in the right way for Alphabet.
How big of a deal is it, Angelo, that we finally got this cash return, right? That we got this dividend being paid out by Alphabet of 20 cents a share. Is it more that like they kind of had to do this, or investors were going to be disappointed?
Yeah, no, I think there's a little bit of that, to be honest with you. I mean, after your biggest competitor out there or peer within the digital ad space kind of, goes out and blows it out, in early February and comes out and throws out a big, buyback plan as well as, initiates a dividend, I think there's definitely pressure from the investment community out there for you to do the same, especially when you kind of look across the Mag 7 names outside of, I think, Tesla and Amazon. I think these guys are all now doing both the buybacks and the dividend. The dividend is very small. It's not necessarily going to have any impact in terms of, their ability to kind of, pay it out at any point in time, even if that business model over time sees some sort of hiccup. So I think it's just kind of a small little olive branch out there for investors. And the buyback of $70 billion is roughly in line to what they announced the last 2 years. So no change on that side of things.
Alphabet earnings have been a bit of a black box over the years. Just wondering how much conversation you expect to hear on AI after the bell. Their Gemini offering has received a lot of criticism, just being a little bit late to the party, but they've sunk a lot of money into this, and you got to imagine they got something ready to reveal at some point in the future. Just how much are they willing to talk about that today?
Yeah, so I personally don't think you're going to hear a lot about, you're going to hear a lot about AI. They'll definitely talk it up and kind of talk about the opportunities of AI, across their cloud ecosystem, as well as kind of instilling it across, their different platforms out there. But that said, you're not going to hear much in terms of product launches or anything like that. I mean, they just had the Google Next event about 2 weeks ago or so, and they throw out some good positive news on that side of things. But when you kind of look at how the calendar is shaping up here, right, you kind of go into mid-May here, and you've got the Google I/O conference on May 14th. That's where you're going to get the commentary in terms of new capabilities from Gemini across their Android ecosystem, as well as kind of new product launches that they're going to ramp on the hardware side of things. So Google I/O is where we expect the catalyst to be as far as AI is concerned. And then, also for Microsoft's state, you're going to have the Microsoft Build Conference on May 21st. You've got, the Developers Conference for Apple on June 10th. And of course, you've got kind of, NVIDIA mixed in all across there. So there's going to be a lot of AI stuff in terms of the calendar coming in, mid to late May into June.
And Angela, just one last one on Alphabet before we dig into Microsoft a little bit more. What about how much they're spending on AI? I mean, that seemed to really be the issue for Meta, the capital expenditures planned for AI development this year. You talk about all the AI news we've gotten, the AI news we're expecting from Google and Alphabet. Do they have more leeway when it comes to how much they're spending there?
So, the good news actually is when you look at the fourth quarter results that they posted out there, they actually kind of alluded to kind of a big step up in terms of CapEx. And you actually did see a big, step up in CapEx from Q3 to Q4 of last year. So the trajectory was already there that there was going to be a massive pickup into 2024 and even into 2025. So, the street's been prepared for that. I don't know exactly what the CapEx number here was for Q1. My guess it was somewhere roughly in line to our expectations out there. At least when I looked at Microsoft, that also, it was actually slightly below what our expectation was for the March quarter. But for Alphabet, as we kind of look ahead here, through the rest of this year and into next year, we do think they've got a competitive advantage out there in terms of their custom silicon business. We do think they're ahead of the game relative to the other cloud players out there. So that is one advantage we do think they have in terms of the cost side of things and what they've done on the custom silicon side.
All right, want to bring it back to Microsoft now. It remains your highest conviction call in the big tech space. Recently upped your price target to $475 from $455. And what I was noticing right after the results is we saw on the back of their cloud strength, we saw shares of Amazon rising 3-4% now. And just in general, seems to be a lot of enthusiasm here behind these results.
Yeah, so I would agree with that. I would also say, it probably also, it's probably up also because of the Google Cloud news too, because we definitely saw a beat on that side of things. So it's rightfully so for Amazon to kind of take that move up because you're probably going to see an acceleration on that side of things as well. So I think all indications point to, unlike what we heard from Meta last night, where Zuckerberg was essentially preaching patience in terms of AI. What you're seeing here on the cloud side of things is, there's a big step up in terms of CapEx, they're getting a lot more GPUs on their ecosystem, next-gen GPUs, and as they kind of throw that capacity online, they're able to kind of charge up in terms of the cost on that side of things. So they're monetizing AI right now, and that's a big difference on the cloud side of things, maybe relative to what Zuckerberg is doing on the Meta side of things, and it's going to take a little bit longer there. So we like kind of the numbers here as far as both Microsoft and Google is concerned for the cloud. We think the momentum will continue actually throughout 2024, and they are lapping some kind of weakness in terms of some of optimizing some workloads in 2023. So you've also got that they're benefiting from.
Angelo, I keep trying to understand the AI opportunity, which I think is still, it's still early, obviously. They're doing great on the cloud from it. It's less clear to me what they're doing from their AI-empowered products, like a Copilot. I look at their PC business. I mean, their Windows revenue was up 11%. That's fine, right? But, this sort of like transformational promise that everybody's been talking about. Do we see that anywhere there yet?
So, I mean, I've got to dig through the numbers a little bit more, but I'll be honest with you, you're probably not going to see it yet. I mean, in terms of Copilot or all the Copilots that they're ramping across their ecosystem, that is going to take time. I mean, Microsoft did allude to the fact it's going to be more of a second half calendar 2024 event, more and even into 2025. It's going to be more of a slower slog. You've got to get those kind of enterprise customers out there willing to pay for these Copilots out there. And it's going to be difficult. I think that's an issue that's not only a Microsoft issue right now, but it's across kind of the entire enterprise software space. And you've actually seen it in terms of the performance of a lot of these companies right now. And I think what you're seeing, at least on the enterprise software side of things, is there's a lot of new AI capabilities getting thrown at these guys right now in terms of the customers. And I think right now a lot of these customers are just holding back, kind of digesting, looking at what the opportunities are out there before they actually are starting, before they're willing to start paying for some of these services out there. So it's going to be a slower slog. I think it's definitely, you're going to start seeing it in the numbers over the next kind of couple of quarters and years. It's going to be more incremental in nature. But that said, I mean, listen, you're going to have kind of seat growth definitely slow down on the Office side of things. The hope is that, average selling prices start to pick up, as you get more contribution on the Copilot side of things.
All right, got to leave it there, but appreciate your time and insights here, Angelo.
Great, thanks, Amy.
You bet. Still to come, we're taking a deeper dive into the latest earnings report from Intel, as those shares are sliding after hours, down about 8% here. We also have Snap shares. They are soaring on upbeat sales guidance, so stay tuned. More market domination over time coming up. Let's get you up to speed on today's action from Tasty Trade. Today's action in the market, and this is sponsored by Tasty Trade. You can see the Dow closed the day down 375 points, good for about 1% of losses. S&P 500 down 23 points, about 0.5%, and the Nasdaq down about 64 basis points, and even 100 to the downside there. Julie.
Let's talk about one more company that is out with its earnings. It's Snap. There are more, but we're just focusing on a few. Reporting its first quarter numbers, the social media company did top analyst estimates and also came out with a forecast above estimates. So Snap says second quarter revenue will be $1.23 to $1.26 billion. Analysts have been looking for $1.21 billion. We should also mention, unlike some of the other large cap tech stocks that we talk about and social media stocks we talk about, the shares have not done well going into this. So that's something to put this in perspective. You're really seeing a bounce back in shares after some pretty lousy performance here. The company also reporting an unexpected gain, an unexpected adjusted earnings per share of 3 cents. Analysts have been predicting a loss of 4.8 cents. That's for last quarter, for the first quarter, and also adjusted EBITDA that was positive, where analysts have been looking for a loss. So that too looks like relief. Revenue beating estimates as well. And then, of course, there is also all the buzz about what's going to happen with TikTok. And we have seen that as this bill got passed, that is forcing divestment of TikTok or a banning of TikTok, that Snap shares have been reacting positively.
Yes, and if we go to the Wi-Fi Interactive, just a quick point on Snap. Here we see an extended hours trading up 28%. That is a huge number there, but this is a very volatile stock, and you can see it's already down. It's lost 1/3 of its value, still in the bottom end of the trading range. This was something, let me just pull this up one more time. There we go. So this is a 3-year look. You can see it's down 81%, and here's a full pandemic round trip where it skyrocketed to all-time highs in 2021, came back to the ground, and just really never able to take off again. Having said that, I was going through the results. They gained daily active users. That was a big beat there, 422 million versus 420 million, so a beat by 2 million. Most of those beats, the beat in the number, most of those coming from the rest of the world. So that's outside of North America and Europe. But that rest of the world average revenue per user is $1.13 versus North America, $7.44. So they're gaining users around the world, but they're in that lower cost bracket.
And they also touted the increase in use of Spotlight, which is basically their answer to TikTok's scrollable feed of videos. Let's get back to Intel. It beat first quarter earnings estimates, but guidance for the second quarter disappointed Wall Street, and shares are down in after hours, trading by some 9%. Here to discuss, Corey Johnson, the Futurum Group Chief Market Strategist. Corey, it's great to see you, as always.
Always.
You know, investors clearly have lost some patience with Intel here.
Yeah.
And they are just not gaining the necessary traction. Give us your sort of big picture read on the quarter.
It was an interesting quarter and disappointing guidance, surely, for the next quarter. And we'll get into the interesting part, but I think when we talk about the market part, the stock part here, you know, I think what you see is investors kind of taking a swing. Is this going to be the quarter when Intel turns around? Is this going to be the quarter when they get the orders for the foundry business? Now, of course, we got a warning a few weeks ago. The foundry was not going well. We kind of knew that coming into this. But I think the guidance, and we'll hear a lot more on the conference call shortly, but the guidance suggests that the issues really are about getting new customers for the foundry business, customers beyond Intel for the foundry business. But and that, you know, we've seen some hints in the semi-cap equipment makers, what we've heard a little bit from ASML and others, that maybe it's happening, but slowly. So we'll see with some more detail on the conference call. But on the other side, there were really good green shoots in the stuff that they make. The actual chips that they're making, their client products business is up 35%. I mean, really strong. The notebook business up a lot. So really strong performance from the stuff that they make. But the making of chips is proving to be a problem for them, and getting into the business that TSMC has dominated for many years.
And how do you think their new Gaudi product fits into that scheme, where they really do have to compete with a huge foundry business in the form of Taiwan Semi, and also lots of players around the globe are getting some of that stimulus money, the CHIPS Act money that's being targeted for chip makers and is starting to be deployed.
All right, so 3 issues you brought up. I'll talk to all of them. Let's talk about Gaudi. Let's talk about where they are in the manufacturing. Let's talk about CHIPS Act, starting with CHIPS Act. They have received more money from the CHIPS Act than anyone else out there. So they're in a really strong position building out their facilities all over the country, in particular in Columbus, Ohio. There have been mixed reports about how fast that is going, but I was struck by the day that the Wall Street Journal announced that they were slowing down the construction in Columbus, Ohio. I had just left the great city of Columbus, Ohio, and seen the facility, and they're building fast. Indeed, they were closing roads at the moment the Wall Street Journal's report came out. So they're clearly pushing ahead really fast there and getting a lot of money for the CHIPS Act, and that is good for the foundry business, right? The second thing we're going to talk about here. So the foundry business ultimately is going to be very difficult to do, but they are pushing ahead at really having cutting edge foundry services, and as you mentioned, in the angstrom levels at the real cutting edge, which we haven't had in this country for many, many years. And in terms of how successful Gaudi is going to be competing with AMD and yes, hopefully competing with NVIDIA, it's frankly just too early to tell. The designs are fantastic, but we'll see what they get in terms of client wins. I mean, NVIDIA is really sucking the air, all the oxygen out of the data center business with what they're making out there, and it hasn't left a lot of room for AMD, and Intel's not there yet with Gaudi, but the designs are certainly promising, so we'll see if customers actually go for it.
Corey, even though the foundry hasn't been seeming to go as fast as investors want it to, generally it has seemed to be the sentiment that Pat Gelsinger, the CEO, was doing the right thing by, sort of reorienting. At what point does that sentiment go away? Right? How, this is the story.
I think you're right. How long is his leash?
Exactly. This is the question I keep
asking. Is he taking a long walk off a long pier?
Exactly. How patient are investors going to be with this? Because you're on the pier.
Why not? Yeah, why not? Look, who knows how patient investors are going to be? I mean, the thing about investors' patience is it goes away really fast. And they're patient until they aren't, and then they abandon a stock quickly. And I don't think that's what you're seeing right now. Now, 9% is a good move after hours. But as you mentioned, the stock hasn't done much compared to a lot of other semiconductor companies in the terms of the stocks, the Philly stocks, if you want to. It's one of, if not I think it's the second worst performer in the last year, in a year that has been great for semis. Now, is going into the foundry business the smart thing for Intel to do? Well, certainly it will. It will diversify them away from the issues that they've had around slowdowns in the PC business. Really, when the PC business catches a cold, Intel catches a fever, and it has always been thus. So could the foundry business give them lots of other business? Well, only if they execute it really well. Intel's been very good about building foundries for Intel chips for decades. But can they have the kind of open business model that Taiwan Semi has done? That remains to be proven, and I think it's going to be a long ways before we know if they're really good at this. I talked to Pat Gelsinger only a few weeks ago about this very topic. What are you going to do that's different than Taiwan Semi? And his answer to me was not as satisfying as I would have liked. He said, look, we're going to be Taiwan Semi, but we're going to be here. And we need to have diversification of manufacturing of chips. And indeed, when we look at what happened during the pandemic, I think the most difficult lingering issue was the concentration of semiconductor construction, if you will, in Asia. And it has really, it continues to spill out in the global economy. And I think even in the inflation issues we're seeing even now. Insurance, for example, right? The big economic numbers we've seen about inflation coming from car insurance. Car insurance is high because replacing car parts has been difficult and been more expensive than it had been in years past. Why? Because of semiconductor design, semiconductor manufacturing. So these lingering issues in the global economy that came because of the concentration of construction of semiconductors into Asia are going to be solved very slowly. Intel stepped into this very quickly, at least announced their plans for that. But I think it's going to take quite a while till that plays out.
Patience indeed. All right. Thanks so much, Corey. Good to see you.
It's good to see you guys. Thank you.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But we're not done. We'll be back for more Yahoo Finance on the other side. Snap reporting first quarter results. The social media company beating Wall Street estimates for the first quarter. Also, the second quarter sales forecast topping estimates. Joining us now is Third Bridge Global Sector Lead for Technology, Media, and Telecom, Scott Kessler. Woo, Snap is volatile one, Scott. That's all I got to say. I mean, I feel like the whipsaw sort of quarter by quarter and not knowing what to expect. So why did they beat this quarter? I guess I would ask, because it has been pretty uneven here.
Yeah, I mean, it has been a roller coaster to say the least. Look, this is a stock that was over $80 during the height of COVID in September of 2021. So even though we're seeing the stock up over 20% in after hours trading, I mean, I think it was over $16 just earlier this year. So there's been a lot of volatility, but I think most of it over the last few years has really been to the downside. What do they do right in terms of Q1? Look, it's really all been about their kind of re-architecting their advertising technology infrastructure to enable them to basically venture out and capitalize on e-commerce opportunities. So direct response advertising has been kind of the buzzword or the buzz phrase that the company has been indicating for more than a year at this point. And finally, it seems like they are largely completed with the related work. And obviously the uplift in revenues was significant, 21% growth. But when you look at what they delivered the prior quarter, or even what the expectations were for this quarter, I mean, that was a massive beat by all accounts. The question now is, of course, as we were just discussing, how sustainable is what momentum they're trying to create at this point is.
Scott, I was looking at some of their numbers here. So just for instance, average revenue per user in North America is $7.44. That's up from, the estimate was $7.08, and it's up 17% from a year ago. So that's $7.44 in America. Europe, it's $2.04. Rest of the world is $1.13. But the rest of the world is where they got most of their beat on new users, monthly active users, daily active users. Just wondering, in the ad tech scheme, they're building up their ad tech, they're trying to monetize more. Is the game plan to increase some of those average revenue per user numbers around the world?
I mean, that's the hope, right? I mean, essentially and look, this isn't an issue specific to Snap. I think what a lot of companies are finding is user growth is more possible outside of developed markets. But on the other hand, those markets are much harder to monetize. And so that's kind of the tension that you see in these constructs, where the Pareto principle is going to apply, where you have 80% of, say, growth in users coming from overseas, but maybe 80% of the revenue growth coming from the US and developed markets. And so that's something that, frankly, companies are working on. It's not an easy nut to crack, to be honest. And so it's going to require work. But it does seem like Snap finally is moving in the right direction. Whether you look at the overall revenue growth, whether you look at the fact that they're attributing that to direct response and the investments that I alluded to, or the fact that just user gains now have returned to the double digits. You know, all of those things are encouraging. I think a lot of folks, as was alluded to earlier, are wondering how sustainable some of this performance is going to be. They alluded to what their expectations are for Q2. Probably not quite as optimistic as the Q1 numbers would suggest, but perhaps they're just being conservative. And I think it's fair to say that people should feel pretty good about the performance and the outlook.
Scott, how much is the sustainability of the performance dependent on what happens with TikTok as well? The company touting the total time spent watching Spotlight, which is its answer to TikTok, was up 125% year over year.
Yeah, well, look, I guess a couple of things on that front. I think Mark Zuckerberg was asked directly about this yesterday in the context of the Meta conference call, and he said what I'm going to say. It's kind of too early to tell. We have no idea what's going to happen with TikTok. I think it's pretty clear that their parent company is going to, fight efforts to ban it in the U.S. That makes a lot of sense. But there are so many unknowns here. Nonetheless, I think at the least, what's going on potentially with TikTok is, I think, rightly seen as a potential positive for Snap. I do kind of wonder, though, whether or not as I said, the performance here is sustainable if they have this kind of positive momentum, or if expectations are going to get too optimistic and there are other issues that the company has to deal with. We've heard repeatedly from experts that Snap is in a tough spot. This is a company that is oriented around kind of protecting privacy and personal data and brand advertising. And that's not where the world is right now. It's why performance advertising is so important. It's why they've been working on this for the past year. I'm just not entirely sure that Snap has all that they need to have at this point to really be successful over the longer term in this context. I guess we'll find out over the next couple of quarters, but this is a pretty good start to the year for sure.
It's been a comeback story before. We'll have to see if it is again. Scott Kessler, thank you.
Thanks a lot.
You bet. Stay tuned here. More Yahoo Finance on the other side. High mortgage rates sticking around as they continue to climb past the 7% threshold. Elevated rates lending to wealthy buyers purchasing homes with cash, leading to a rise in prices. According to Redfin, luxury home prices rising twice as fast as non-luxury prices in the first quarter. Joining us for more on the latest trends among affluent buyers, we have Brown Harris Stevens CEO Bess Friedman. Bess, thank you for joining us here today. So just give us an overview here of the luxury market versus the rest of the real estate market.
Well, I think the luxury market is also being challenged by what's going on with rates, although a lot of the time, and last year we saw a lot more cash buyers, and we're seeing more of that even in the first quarter of this year. It still has an impact with the higher rates. And then first-time home buyers are really highly impacted by these higher mortgage rates. And so we've seen a slowdown with sellers and buyers last year because of the higher rates. And it's continued into 2024. The first quarter was not a great quarter, let's be honest. The housing market is stalled because of a lack of inventory in certain places, higher rates, and prices have stayed higher because of that. But the month of April, so far, it's looking a little bit better. We're seeing incremental progress in the housing market. Look, there was a lot of money for the Wall Street bonuses. I think it was something like $33.8 billion was paid last year. A lot of cash out there, so we're seeing a lot of cash buyers as well. So it's not awful, and it's not champagne and caviar.
Talk to us about price, because we mentioned that figure coming from Redfin. On the other hand, we've seen some stories in the press about how luxury sellers have had to cut their prices and sort of come back to earth a little bit after what we've seen the past few years.
Yeah, I mean, it just depends on how do you define luxury. So in Manhattan, we have this sort of measure that, over $4 million it is probably luxury, but for the rest of the world, that's crazy numbers, right? And so it just depends. But Manhattan is a little bit different. We kind of put that in a little bit of a bubble, similar to Palm Beach and certain areas of Connecticut and the Hamptons. But the rest of the country, those prices are crazy. And I would say over $1 million is probably considered luxury. And most of those people who are spending $1 million are getting a mortgage. And so the rates they're very sensitive to, and they're very value focused. So if the rate is a little higher, they want to do better on price. So I would say they should talk to a mortgage professional and talk to a real estate agent who can guide them so they can find something that is affordable for them every month.
What about inventory? Talk to us about that, because we still have we have people sitting in their homes with 2.5% and 3% mortgages. They don't want to sell necessarily. How does this look in the luxury market?
I mean, that's a little bit different. So what you just said about the sellers that don't want to put their homes on the market, they don't want to let go of those low rates. And why would they? Unless they're motivated to sell because of a change of life or a new job, they're probably going to stay in their home for a little while. But luxury is a little bit different. And that's why people are paying cash when they can, because they're not going to be impacted by the rates. So the luxury market has done okay, but still, because of what's going on, there's chaos in the world. And that distracts people. We have 2 wars going on. It's an election year, as we all know. It's a hot topic everywhere. And, the media, the news cycle keeps people distracted. So I think we're in a little bit of an environment where there's a bit of uncertainty, and that kind of keeps people on the sidelines, which is why it's been a little bit slower in housing, including luxury, because that's discretionary. And when people see that things, are working a certain way, this way, that way, rates have gone up, the stock market has done well, they kind of hold off.
Bess, we got to leave it there. It's been a busy day, but we'll have you back soon. Talk more about all of this.
Nice
Appreciate
to be
it.
here with you guys.
Thanks
Take care. Thank you.
Coming up, we're telling you everything you need to know to kickstart your Friday. Stay tuned. More Yahoo Finance on the other side. It's time now for What to Watch on Friday, April 26th. After the week GDP reading on Thursday, all eyes on a key inflation reading ahead of the open tomorrow. The March PCE report is due. Economists are forecasting the Fed's preferred inflation gauge will rise 2.6% from a year ago, and excluding volatile food and energy prices, it's expected to rise 2.7%. Earnings season continues with oil giants reporting tomorrow. Exxon and Chevron both announcing first quarter numbers before the bell. Wall Street anticipating profits will drop for both despite rising oil prices.
And that's not all. We're going to be getting earnings from AbbVie, Colgate, Palmolive, and New York Community Bancorp. NYCB posting its first earnings report under new management. Analysts looking for how the regional bank handles its $1 billion equity infusion last month and continuing CRE loan challenges.
Well, that'll do it for today's Yahoo Finance Live. We're wrapping up Take Your Child to Work Day. My son, Abraham, AB, he's back with us here at the desk for the second year in a row. There is one more thing that is happening tomorrow, by the way, in our What to Watch. It's your birthday tomorrow.
Well, there you go. Can't believe
AB's
we
turning
missed that.
12. It's very exciting. We should have put that in our What to Watch because everybody should know so they can celebrate. You excited about it?
Yep.
Ice cream cake? You a fan or no?
Yes.
He likes the Carvel ice cream cake. Usually that's the.
Doesn't get any better than, what is that, the whale? Yes.
Fudgy the Whale.
Fudgy the Whale.
Fudgy the Whale. All right, AB, thanks for coming in today. Thanks, everybody, for watching. Come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell.